Hey everyone, welcome back to the AI Tech channel. Today, we're diving deep into a company that's been making some serious noise lately, IBM. The big question is IBM truly the AI investment of the future, or is this just another case of tech hype? Stick around, because we're about to break it all down. Is IBM a golden opportunity or a ticking time bomb? Let's find out. Okay, so what's the buzz all about? Well, recent articles are pointing to positive momentum for IBM, especially with its focus on AI and the growth of Red Hat. We're seeing analyst upgrades, like the one from RBC Capital Markets, and some really solid earnings reports. This is definitely boosting investor confidence, and we could see the stock price climbing higher in the short to medium term. Think about it, who doesn't want a piece of the AI pie right now? But it's not just retail investors getting excited. Word on the street is that IBM is becoming a very popular stock among hedge funds. This is huge. When these big players start adding a stock to their portfolios, it can create significant buying pressure, further driving up the price. Are the smart money guys seeing something we're missing? Let's dig deeper. So, what's attracting all this attention? It seems like IBM is really pushing hard on its AI strategy. They're talking about an AI turnaround for the ages and boasting some impressive numbers in Gen AI bookings. This is likely attracting investors who are specifically looking for AI-related opportunities. You know, the kind of investors who are always on the hunt for the next big thing. The AI gold rush is on, and IBM wants to be the leading miner. And here's another angle to consider. Some analysts are even asking, is IBM the best dividend stock to buy and hold? This suggests that IBM is being considered not just for its growth potential, but also for its dividend yield. This could attract a whole different type of investor, the income-focused folks who are looking for a steady stream of passive income. Is IBM a safe haven in a volatile market? That's the million-dollar question. Now, let's think about what all this positive feedback means for IBM itself. All this attention is likely to reinforce their strategic focus on AI and related technologies. We can expect to see even more investment in research and development, and maybe even some strategic acquisitions in the AI space. They're going all in on AI, folks. Are they playing it smart, or are they putting all their eggs in one very risky basket? And we can't forget about Red Hat. The strong growth of Red Hat is a major highlight, showing just how important this subsidiary is to IBM's overall performance. This could lead to even more investment and integration efforts to further leverage Red Hat's capabilities. Red Hat, the unsung hero of IBM's success story? It might just be. Okay, so let's zoom out a bit. What's the ripple effect of IBM's AI push? Well, for starters, the increased AI investment and development, as exemplified by IBM, is going to drive massive demand for data center infrastructure. This is great news for companies in that sector. Think about it. All that AI needs a place to live and compute, which means data center stocks are hot property right now. And it doesn't stop there. As companies like IBM integrate AI into their offerings, there's going to be increased demand for AI software, tools, and services provided by other companies. This could include everything from machine learning platforms to data analytics tools and AI consulting services. In short, it's a massive opportunity for anyone involved in the AI ecosystem. Remember those hedge funds we talked about earlier? Well, the article highlights the success of AI-driven hedge funds like Renaissance Technologies. This could encourage other hedge funds to adopt or expand their use of AI and machine learning in their investment strategies. It's an AI arms race on Wall Street, and the stakes are incredibly high. And finally, as businesses look to adopt and implement AI solutions, there's going to be increased demand for IT consulting and services to help with integration, deployment, and management of AI systems. Companies need experts to guide them through this complex landscape. This is where the IT consultants step in, becoming the indispensable navigators of the AI revolution. Now, let's talk about the elephant in the room, jobs. Increased investment in AI will likely lead to the creation of new jobs in areas such as AI development, data science, and AI-related engineering. But, conversely, the adoption of AI could lead to displacement of workers in roles that are easily automated. It's a double-edged sword, and we need to be prepared for both sides. Retraining and adaptation are key. On the whole, AI has the potential to improve efficiency and productivity across various industries, leading to significant economic growth. It can also drive innovation by enabling new products, services, and business models. But with great power comes great responsibility. The potential is there, but we need to harness it wisely. The increasing use of AI raises some serious ethical concerns. We're talking about bias in algorithms, fairness, and transparency. We need to think carefully about these issues and develop ethical guidelines and regulations for AI development and deployment. Are we building a fair future, or are we baking in the biases of the past? This is a question we all need to be asking. And let's not forget about data privacy. The use of AI also raises concerns about data privacy and security, requiring robust data protection measures. We need to ensure that people's data is being used responsibly and ethically. Your data is valuable, and it needs to be protected. The growing importance of AI will require investment in education and training programs to develop a workforce with the necessary skills in AI, data science, and related fields. We need to prepare the next generation for the AI-powered world. Education is the key to unlocking the future. Finally, increased investment in AI could lead to a shift in investment away from other sectors. The hype surrounding AI could also lead to market volatility as investors try to identify the winners in the AI space. It's a wild ride, and investors need to be prepared for some ups and downs. Now, let's dive into some potential risks. The article highlights the ongoing debate about AI's ability to consistently outperform human experts in stock picking. Can we really trust AI to make all our investment decisions? This is a serious question that every investor needs to ask themselves. AI-driven hedge funds often use proprietary algorithms, and the inner workings of these algorithms are often opaque. This makes it difficult to understand why a particular investment decision was made, hindering risk assessment and potentially leading to unexpected losses. It's like driving a car without knowing how the engine works, risky, right? AI models are only as good as the data they are trained on. If the data contains biases, the AI may perpetuate or amplify these biases in its investment recommendations. Garbage in, garbage out. We need to be aware of the potential for bias in AI algorithms. AI models can become less effective over time as market conditions change. Additionally, models can be overfit to historical data, performing well on past data but poorly in new, unseen situations. Past performance is not indicative of future results, especially when it comes to AI. AI-driven investment systems rely on vast amounts of data and complex algorithms, making them potential targets for cyber attacks. A successful attack could compromise the integrity of the system, leading to financial losses or market manipulation. The stakes are high, and the security needs to be airtight. The article mentions generative AI bookings, but the long-term impact isn't proven, and there's a risk that it won't deliver the expected returns. Don't get caught up in the hype. Let's see some tangible results before we declare it a game changer. External factors, like trade tariffs and an AI bubble, can significantly impact the performance of even the most sophisticated AI-driven investment strategies. Relying solely on AI without considering broader economic and geopolitical risks is a serious business risk. Keep your eyes on the horizon, folks. Past performance is not indicative of future results. Hedge fund performance can vary significantly, and there is no guarantee that AI-driven funds will continue to outperform the market. Don't put all your faith in past glories. As more investors adopt AI-driven strategies, the market becomes more competitive. This arms race can drive up the cost of data and computing resources and may diminish the effectiveness of individual AI models. It's a constant battle for supremacy, and only the fittest will survive. The use of AI in finance is a rapidly evolving area, and regulatory frameworks are still under development. Changes in regulations could impact the legality or profitability of AI-driven investment strategies. The rules of the game could change at any moment, so stay informed. Over-concentrating investments in a few AI-selected stocks or mirroring hedge fund strategies too closely can increase the risk of significant losses if those specific investments perform poorly. Diversification is key to mitigating risk. While the article mentions positive analyst ratings for IBM, there are always business risks associated with investing in a specific company. These could include competition, technological change, and economic downturns. Never forget that investing in any single company carries inherent risks. The black box nature of some AI algorithms raises ethical concerns about transparency and accountability. It can be difficult to explain investment decisions to clients or regulators, particularly if those decisions have negative consequences. We need to demand greater transparency from AI systems. As mentioned earlier, AI models can perpetuate or amplify biases present in the data they are trained on. This can lead to unfair or discriminatory investment outcomes for certain groups of people. We need to ensure that AI is used fairly and equitably. The increasing use of AI in finance could lead to job displacement for human financial analysts and traders. This raises ethical concerns about the social impact of AI and the need for retraining and workforce development programs. We need to prepare for the changing landscape of work. Sophisticated AI algorithms could potentially be used to manipulate markets or gain unfair advantages over other investors. This raises ethical concerns about market integrity and fairness. We need to be vigilant against the misuse of AI. When AI systems make investment decisions that result in losses, it can be difficult to assign responsibility and accountability. This raises ethical questions about who is responsible for the actions of AI systems and how to ensure that they are used responsibly. Who's to blame when the AI messes up? A question we need to answer. Overly optimistic claims about AI's capabilities can mislead investors and lead to unrealistic expectations. This is an ethical concern related to honesty and transparency in marketing and communication. Don't believe the hype. Do your own research. So, is IBM a smart AI-powered investment or an overhyped gamble? The truth is, it's a bit of both. The company is clearly making a strong push into AI, and there's a lot of potential for growth. But there are also significant risks to consider, from market volatility to ethical concerns. The key is to do your own research, understand the risks, and invest wisely. Don't let the AI gold rush blind you. AI offers potential benefits for investment, but it also introduces significant risks that investors need to be aware of. A balanced approach that combines AI with human expertise, critical thinking, and a strong understanding of market dynamics is essential for responsible and successful investing. Remember, AI is a tool, not a magic bullet. Use it wisely, and good luck with your investments. Thanks for watching, and we'll see you next time on the AI Tech channel.